Hello everyone. In this video I'm going to talk about distributions to shareholders. And we're going to start off by talking about the relationship between distributions and firm value. So for any investment, to have value today, the investor must believe that they, or someone on their behalf, will receive something of value in the future from that investment. Typically, when we think about things like stocks, that something of value in the future is cash. So either in the form of dividends, coming from dividends, or through stock repurchases, which we're going to talk about a lot in this topic area. It can be other things. You could invest in a farm, and in exchange for your investment, you might get farm goods, you might get produce or beef or pork or something like that in the future in exchange for your investment today. We see that sometimes, but primarily when we think about investments, what we're getting back in return is cash. And so that's what we're going to talk about in this topic area. We're going to talk about how firms distribute cash to their stockholders and how that can impact the value of the company. So what I have here is a question that says, can a company increase its value through its choice of distribution policy? And the answer is yes. And we're going to see this as we take a look at this topic. Companies can affect their value by their choice of distribution policy. Back in 2003, when Microsoft first initiated a dividend, this actually hurt their stock price. This is because the investors in Microsoft, at least many of the investors in Microsoft, believed that Microsoft was a growth company, and a growth company is one in which they're really not. A high growth company is one in which they're really not paying out dividends yet, because they've got a lot of great investments, a lot of great things they can put the earnings that they're making into and further increase the value of the company. And so what happened was that when they announced that they were initiating a dividend back in 2003, the stock price for Microsoft dropped a meaningful amount at that time, because they were signaling a change in the growth stage of Microsoft. So the choice of distribution policy can affect the value of the company in the market. So distribution policy generally consists of three things: the amount of the distribution, the frequency of the distribution, and then finally the type of distribution. The target distribution ratio is the percentage of net income distributed to shareholders through either cash dividends or stock repurchases. The payout ratio is the percentage of net income paid out as cash dividends. Finally, the optimal distribution policy must strike a balance between cash payments and capital gains to maximize the stock price. And so what this last item means is that if a firm is paying out all of their income and all of their excess cash flows that they generate from operations, if they're paying those out to investors and not reinvesting in the firm, that's going to limit the growth of the firm's stock price. So you might get a lot of dividends today as a stockholder, but if the company is not reinvesting in itself, the stock price really isn't going to grow, or it's not going to grow very quickly. And so the balance is finding the right amount to pay out to continue to grow the stock price, the capital gains, the change in the price of the stock, versus giving your investors cash today. So a recent history of cash distributions, I put down here a note that says see Yardeni research, and I put this out on D2L for you as well. This is a report put out by Yardeni Research. Unfortunately, soon after they put this report out, they stopped issuing these reports, so we won't be able to get more of these reports from them in the future, but I sent them a thank you right after I pulled up this report back in March of 2023, saying, I appreciate this, I use it in my classes, and I'm glad that you put this out there. And they said, unfortunately, we're actually going to stop with that, but again, it's a really good bit of research that they put out there. Dr. Yardeni actually came to Washburn University a few years ago and gave a presentation for the School of Business. So this is it goes through March 10th of 2023, and it shows the buybacks of and that's stock repurchases and dividends for firms in the S&P 500. So the 500 largest firms based on market capitalization in the United States. This is the billions of dollars annualized of the stock repurchases. And we can see here that stock repurchases tend to be pretty volatile. And that's one thing to keep in mind here. This information goes back to 1999, and I can tell you kind of what happened prior to 1999, and we'll look at a little bit of the history once we get back to the notes. But note here that during times of recession, so right here in 2009 and 2010, we had the Great Recession. In 2020, we had a very brief recession, but it was due to COVID. You can see that stock repurchases declined dramatically during those time periods. And that's something to remember we're going to come back to. Now, this is dividends, so that was stock repurchases or stock buybacks. And this is dividends. And you can see here that dividends aren't as volatile. We saw a dip in dividends here in 2009 and 2010, again, as a result of the Great Recession. But we saw a little dip here in 2020, 2021 because of COVID, but not nearly as significant as what we saw with stock repurchases. We see that dividend amounts, this is the amount of dividends paid out by S&P 500 firms, went up consistently over that time period. And I'm just looking at the scaling down here. So it goes actually from $50 billion up to almost $600 billion, about $560 billion here. $562 billion here at the end of 2022. Note here how much more is being paid out, although it's hard to tell from the graph. But if you look at the dollar amounts here, the total amount of dividends paid out, again, is $560 billion at the end of 2022, compared to, we get to a high here of $1.15 trillion in buybacks in the, appears to be the second quarter, or the first quarter, of 2022. So there's a lot more activity with stock repurchases in terms of dollar amounts of repurchases than there is with dividends. Back in, you can see here on the graph too, the late 90s, early 2000s, stock repurchases actually outpace dividends. Firms were paying out more cash in the United States through stock repurchases than they were with dividends. So I'm going to go back to the notes here. I wanted to show you this, and again, this is actually a much longer report. It's got some really interesting stuff in it, and you can see that out on D2L. So a little bit of history here. Firms in the United States can repurchase stock through two means. They can do it through open market repurchases, and that's really most of the repurchases we see, or through tender offer repurchases. Open market repurchases take place in the stock market. While tender offer repurchases tend to be targeted and negotiated. They tend to be larger repurchases, the tender offer ones do, and they want to keep them out of the market because they don't want those repurchases to affect stock prices. So if the company went out and repurchased a lot of stock out in the market during a day, and we're going to actually talk about why they're not allowed to do that, but if they did that, that would affect stock prices. That would actually push the stock price up momentarily. It's not allowed generally to purchase large amounts of stocks during one day, but these do tend to be larger ones, and they are negotiated outside of the marketplace between the company and the investor that they're negotiating the repurchase with. So we're going to focus in here on open market repurchases because that's the majority of repurchases that occur in the United States. Outside of the United States, open market repurchases are much rarer. There's not a lot of countries that allow open market repurchases, but we're going to talk about why the United States does allow them and under what conditions. So open market repurchases really started in the late 1980s in the United States, and it was because of a regulation that was passed in 1982. In 1982, the Securities and Exchange Commission issued Rule 10b-18. There's nothing special about that number. It's just where it ends up, where it's at in the code. This is referred to as the safe harbor rule. Firms had to be careful before 1982 because the SEC could accuse them of trying to manipulate their stock prices if they were repurchasing stock in the market. So they didn't. So this is referred to as a safe harbor rule because it put in place guidelines that if the companies follows these guidelines, then they're okay from the point of view of the SEC, saying that they are not trying to manipulate stock prices through their repurchasing of stock. So Rule 10b-18 set out four different rules four different conditions that firms must meet in order to fall under this safe harbor. And if they don't meet these four conditions, they're no longer in that safe harbor, and they can be accused of trying to manipulate their stock price through their stock repurchases. So the four conditions are these. The first is that there's a limit, the first is that the company has to purchase all shares from a single broker during a single day. So the company can't use multiple brokers during the day. They can switch brokers between different days, but they have to stick with one broker for one day. The second is that essentially the firm can't be the first or the last purchaser of the stock that day in the marketplace. So, and it depends on the size of the company. Larger firms are given a little bit more leeway, so they can purchase within the after the first 10 minutes or and just not within the last 10 minutes of the day. For smaller firms, those smaller firms have to wait until 30 minutes have passed in the day, and they can't trade within the last 30 minutes. So in general, though, the idea is that they can't be the first or last trades during the day. The third condition is that the price paid cannot be more than the highest independent bid or the last transaction price quoted. In other words, they can't be pushing the price up through their trades. And finally, the volume of shares traded by the company or purchased by the company in the day can't be more than 25% of the average daily volume for that stock. Rule 10b-18 also put requirements in regarding reporting these trades that companies have to follow. And so they, in general, companies month to month have to provide information on how many shares they've repurchased, the average price that they paid, the number of shares purchased under publicly announced repurchase programs. And I'm going to talk about those here in a minute. And then the maximum number of shares or the maximum dollar amount that the firm could repurchase under these programs. So I'm just going to make a note here. I don't expect you to remember all those things, but the firm does have to. So this is not one of the 4 trading conditions, but the firm in the United States, firms can repurchase stock after that repurchase has been authorized by its board of directors. And I mentioned other countries, so we don't see a lot of repurchase activity really outside of the United States. There are, like I mentioned before, there are a few countries in the world where we do see some, but in most other countries, the firm has to get permission from its stockholders directly to engage in stock repurchases. In the United States, that's not the case. They can, because of Rule 10b-18, the firms can just get their authorization from the board of directors. So it makes it much more likely that the firm can repurchase stock and will repurchase stock because of that. So stock repurchases are authorized by the board of directors. And so typically there would be in many cases, an announcement from the firm that during its quarterly board meeting, the board of directors authorized the repurchase of a certain number of shares or a certain dollar amount of shares. One key thing to know is that the company is not required to actually go through with the stock repurchases. And this can become very important because oftentimes when a company comes out and announces a stock repurchase plan has been authorized, that'll actually increase the value of the stock, and we'll talk about this later, because it's sending a signal about the company to the marketplace. I did research on this many years ago and looked at through an event study, looked at the stock market reaction to open market repurchase announcements and found that the market was pretty good about figuring out if the company was actually going to go through with the repurchase. So when the company actually went through and repurchased most of the shares of stock in the repurchase program on the date of the announcement of the program, so that before they were actually repurchasing the stock price would jump, okay, and not by a huge amount, but by 1 or 2%. But enough that as an investor, that would make you happy. In cases when the firm eventually did not complete the program or substantially complete the program, in other words, they were authorized to repurchase shares, but they just didn't, stock price didn't really move. So the market could kind of tell whether or not the company was actually going to go through with the program. This became important after 9/11. So if you think back, well, if you were conscious of it back in 2001, after the events of 9/11, 2001, the stock market, the New York Stock Exchange was actually shut down for a week. And when everyone came back, stock prices plummeted because people were scared. They didn't really know what was going to happen. And so they started selling their stock. And in order to shore up their stock price, a lot of companies started announcing repurchases. And in fact, the SEC and the New York Stock Exchange allowed companies to not really follow 10b-18 for a while, because they also wanted to see stock prices get shored up. And so the idea being is that companies are going to announce our stock is cheap, and we're going to talk about this later, but our stock prices are really cheap right now. It's a good time to buy. We're repurchasing our own shares because they're so cheap. And so the intended effect was that would shore up stock prices, and stock prices would go back up because people would feel confident. What actually happened was nothing. Investors really didn't respond to these announcements, and companies really didn't follow through on these announcements. So that's one thing to keep in mind. We're going to talk more about that later. It's called the signaling theory, and we'll get into that when we talk about how these announcements affect stock prices. But I wanted to let you know about that. Overall, so this is, this portion of the topic is a recent history of cash distributions. 10b-18 was an important part of that. 10b-18 was actually updated in 2003 to add some additional reporting requirements there. Stock repurchases really started to take off in the 1990s. Part of this was because of a change in the tax code in the United States, which allowed companies to expense all of their incentive compensation for executives, but not all of their salary compensation. So a change in the tax code in the mid to late 1990s resulted in companies focusing on incentive compensation. And what I mean by incentive compensation are stock options and restricted stock and bonuses for executives. Most incentive compensation is tied to the stock price. So what we saw beginning in 1996 was that companies restricted the amount of salary being paid out to executives because only the first $1 million in salary was deductible for tax purposes, and moving what was salary compensation over to largely stock options. So they reduce the amount of salary being paid out, and they increase the amount of stock options, and stock options increase in value when the stock price goes up. So they had an incentive, an additional incentive, to push that stock price up. And what we'll see later on is that whenever we look at stock repurchases versus dividends, stock repurchases have the effect of increasing the stock price at a faster rate than dividends do. And we're going to dig into that a little bit later on, but this is just to explain a little bit why stock repurchases have increased so much since the mid-1990s, when we had a little bit of a change in the tax code there, and how executives really have an incentive to push the stock price up, and stock repurchases as a form of distribution do that. Okay, so that's a little bit of history. I showed you the graphs there that it kept increasing, but stock repurchases are a lot more volatile than dividends. So now we're gonna backtrack a little bit, and we're gonna talk about dividends. So there are several dividend theories, and our dividend theories go back to the 1950s, and they go back kind of to the beginning of finance, because back in the earlier days of the stock market, pretty much if you listed a stock on the stock exchange, the New York Stock Exchange, it paid a dividend, because that's what investors expected. The only way an investor at that time could really get cash from an investment, paid out from the company for their stock, was a dividend. Okay, there were no stock repurchases, and so companies paid dividends, and most of our early theories about cash distributions came from ideas about dividends. So there's two economists that had several theories. We're going to talk about them: Miller and Modigliani, also known as M&M. Not the candy, not the wrapper, but two economists. They had a lot of dividend theories, and they also had a lot of capital structure theories. So you'll see them in a later lecture as well. So Miller and Modigliani, their first theory, called the dividend irrelevance theory, said the firm's value is determined only by its basic earning power and business risk. Investors can create synthetic dividends, so dividend policy is irrelevant. And I put a little question here: how? So investors can create synthetic dividends just by selling off a portion of their stock. So let's say you buy some stock and it goes up by 10% in value next year. Well, you could sell 10% of your holdings and get a nice dividend. Okay, or maybe just 5%. So you have some capital gains there. You get some, increase in the value of the stock. Plus, you get a little cash payment every year. But you can create it yourself, and that's the idea behind this dividend irrelevancy theory. Dividend irrelevance theory is that investors can create their own dividends. So the amount of dividends paid out really doesn't matter to investors, and it should have no effect on the value of the firm. However, M&M assume no taxes and brokerage costs. So how would these affect the validity of the theory? So the taxes between receiving dividends and receiving capital gains can often be different. And so tax rates can have an effect on whether or not this is true. Right now, the tax rates are pretty similar between dividends and capital gains. And let me just explain a little bit here. If you're not familiar with it, capital gains are the increase in value from an investment. So let's say I buy a share of stock for $50 and a year later I sell it for $60. The capital gain in this case is the difference between the two prices. In this case, it's going to be $10, and I would need to pay taxes on that. The tax rate that I would pay would actually depend on a couple of different factors. First of all, how long did I own the stock for? If I bought it and sold it very quickly, that might be counted as ordinary income. But if I hold on to the stock for a little while, then it would be counted as a capital gain and actually be taxed at a lower tax rate. Currently, the tax rates are either 0, 15, or 20%, depending on what your overall income is. The same happens to be true right now for dividends. So if the company pays a dividend and I've owned the stock for a little while, then that dividend is referred to as a qualified dividend. And so it actually has the same tax rate as a capital gain right now. If I just own the stock for too short of a period of time, then that dividend also would be counted as regular income. And so I would be taxed at my regular income tax rate. I'm not going to ask you to memorize and learn all the specific tax rules about dividends and capital gains, but I do want you to know that sometimes there can be a difference in those rates. The big one here is brokerage cost. So whenever you trade stock, oftentimes there's a cost involved that you have to pay your broker. These have actually been declining in recent years. If you go back to the 1980s, it was pretty common to pay $20 anytime you traded a regular lot of stock. And so a lot of stock, LOT, is 100 shares of stock. And so if you traded what's referred to as an odd lot, so less than 100 shares, you'd actually pay a higher brokerage fee for that. This has changed dramatically over the past few decades. Nowadays, there's a lot of investments that you can trade or on certain platforms you can trade without brokerage fees or without commissions. They're making their money in kind of some different ways from that. And certainly you can trade odd lots now. It's pretty common. You can in fact you can trade fractional shares, which is just a portion of a share of stock. So those rules are changing, and this theory is becoming more and more relevant over time because the fees are changing and the tax rates between capital gains and dividends are also kind of coming together, at least in the United States. So in the past, this one wasn't very valid because there was difference in tax rates and because there were high brokerage costs. But as those tend to go away, the theory becomes more valid. So I'll just make a note here. There are brokerage costs for selling stock, and so there isn't, if you receive a dividend, you don't pay a fee to receive that dividend. So the theory is not completely valid. There's an advantage when those brokerage costs exist. There's an advantage to receiving a dividend if you want a dividend. Okay. So let's move on to the next theory here. The next theory is referred to as the bird in the hand theory. So M&M assumed that dividend policy has no effect on the required rate of return on equity. So if you think back to when we calculated the weighted average cost of capital for a firm, Part of that was the cost of equity or the required rate of return on equity, and that's what we're talking about here. There are two other researchers, Gordon and Littner, argued that the required rate of return on equity should fall with the payment of dividends because dividends are less risky than capital gains. So the question I have here is, do you agree with Gordon and Littner? So this is referred to as the bird in the hand theory. If you know your sayings, a bird in the hand is worth two in the bush. Okay. The idea being that a sure thing is worth more than something that's risky. If you're out hunting pheasants, I guess, and you've already caught one, that one that you have is worth more than the two that you might get that are hanging out in the bush over there that you're going to shoot at. The idea behind this is that if you're receiving a dividend, it's a sure thing, whereas a capital gain may or may not occur. The stock price might go up, it might go down. You don't know for sure, but you do know if you're receiving a dividend that you're actually receiving a dividend, and as a result, the required rate of return should decrease because you're facing less risk as an investor with that. The truth is that researchers have found that it is true, the required rate of return on equity is lower for firms that pay dividends than firms that don't. So they were correct with that idea that the required rate of return should be lower, but it's not because the company pays dividends. So firms that pay dividends have less volatile earnings than firms that don't pay dividends. So while the outcome was what Gordon and Littner expected, it's not because the firm was paying dividends that the required rate of return was lower. It's that firms that pay dividends have less volatility in their earnings, meaning that they're lower risk for investors whether or not they're paying dividends. And so as a result, those firms that pay dividends have a lower required rate of return. And this is the idea of endogeneity. And endogeneity is the idea that two variables may be correlated, but there's no causal relationship because there's a third variable there that results in the relationship of the other two variables. And in this case, the third variable is the volatility of earnings. So we have the idea of whether or not the firm pays dividends and the required rate of return for the firm's stock. And again, Gordon and Littner are saying paying dividends results in or causes a decrease in the required rate of return for the firm's stock, when in fact there's a third variable here, and that is the volatility of the earnings of the firm that cause both of those to occur. So paying dividends does not reduce the required rate of return of firm stock. It's the decrease in volatility in the firm's earnings that cause both to happen. This becomes important when we bring stock repurchases into the fold. And we'll talk more about that later. The next theory is referred to as the tax effect theory. And again, this is a theory regarding why companies pay dividends. So prior to 2003, the Jobs and Growth Act, there was a tax preference for capital gains. I mentioned right now that capital gains are generally taxed at the same rate as dividends, but prior to 2003, this was not the case. Dividends were taxed as normal income, and at that time, the marginal tax rate was 38.6%. And capital gains were taxed at a lower rate at 20% at the top marginal rate. So investors should have preferred lower dividend paying companies, because if you received $1 in dividends for the highest margin taxpayers, they were going to pay out 38.6 cents in taxes. However, if they received the same dollar in capital gains, they were only paying out 20 cents in dividends. And so companies should have reduced the amount of dividends they're paying out in order to increase their stock price through reinvestment or possibly through repurchasing stock. So investors should have preferred lower dividend paying companies. So why did companies continue to pay dividends? And the reason why is referred to as the clientele effect. So companies continued to pay dividends because some investors prefer dividends to capital gains. And they want the company to continue to pay dividends as a result. So that brings us to the clientele effect. There are people and institutions that rely on even payments, and few, if any, taxes may prefer dividends. So there are people, specifically retirees, have low tax rates, and so they might not pay any taxes on dividends, or it's going to be a fairly low rate, especially during this time prior to 2003. And so they often also rely on payments to cover their living expenses. There are institutions that also rely on consistent payments, such as endowment funds and life insurance companies and pensions. And in many cases, they don't pay taxes. So there is a preference for dividends from these companies, because if they had to sell stock in order to get their money that they need for, making life insurance payments or making pension payments, or in the case of endowment funds, they often have a required amount they have to pay out every year. If they had to sell stock for that, there would be those brokerage fees. And so they would much rather not pay those brokerage fees and just get a reliable amount of income every year through dividend payments that they can count on. And so there's demand for this type of investment out there that does pay dividends. And as a result, we have a clientele effect. And even back here, sorry, I'm going to scroll up. Prior to 2003, there was a demand for dividends, even though a lot of investors were paying higher taxes on those dividends than they would have with capital gains. And those types of stocks, usually referred to as blue chip stocks that have high dividend payments, attract those types of investors. Additionally, investors that are precluded from selling stock may prefer dividends so that they can receive cash flows. Which investors might be precluded from selling stocks? So there are some investors that cannot sell stocks because they are management or directors of a company. So if you are the executive of a major company or on their board of directors, oftentimes you're required to hold a certain amount of ownership in that stock. You might have a trust fund that owns stock in a company where you might be precluded from selling the stock of that company. And so you would like to get some income, but you can't sell the stock. And in some cases, you have investors that want to maintain a certain amount of control over a company, And so they don't want to sell the stock, but they do want to receive income from that stock. I'm going to show you an example of that here in a moment. So I'm just going to type in here managers and directors of a company. And beneficiaries of trust might be precluded from selling stock. Some investors do not want to sell stock, and so they will avoid, so they will want the firm to pay dividends in order to get income from the stock. So here I've got the definitive 14A, also known as the proxy statement for Walmart. And within the proxy statement, they have to lay out the holdings of major shareholders. And so you can see here that of Walmart stock, the Walton family, so Alice, Jim, John, and Rob Walton are the children of Sam Walton, the founder. And you can see here that they own a lot of shares jointly. And so you can see they each own many shares, here over 1 billion shares each through Walton Enterprises LLC. And then they own all about 287 million shares through the Walton Family Trust. And then individually, they have a little bit of ownership out here as well. And you can see, looking at the percent of class, that together they own almost 50% of the common stock of Walmart. And so they really don't want to sell their stock in order to get income. And so they want dividends to be paid out on this stock, so that they're able to generate income to live off of and make investments and give out and do all types of things without losing their voting control in the stock. And so we often see that with a company like Walmart, where the founding family is still involved with the company. And so that's one reason why there are some investors out there, some clientele that do want the company to pay dividends, and so they don't have to sell their stock and give up their control in the company. So finally, investors that face higher taxes generally prefer lower dividend payouts, because dividends, when you receive a dividend, you have to pay taxes on it. You can't avoid the distribution. With stock repurchases, you can choose not to accept the distribution just by not selling your shares. And we'll get into that when we get into the stock repurchases. The next theory we're going to talk about is the information content or the signaling effect. So dividend increases, and let me say here, unexpected. So let me put the word in here, unexpected. Dividend increases result in an increase in the stock price. It's a positive surprise about the company when it comes out and says they're increasing their dividend, and it's an increase that people did not expect. Unexpected dividend decreases, and in general they are unexpected, because companies rarely want to decrease their dividend. It's a bad sign about the company, but they result in a decrease in the stock price. So according to Modigliani and Miller, the result is due to the information content of dividends. A signal increases that the firm expects earnings to increase in the future, and maintaining the stability of those earnings in the future. So an increase signals an increase in expected future earnings, and stability of earnings in the future. A decrease in dividends is generally a very negative sign about a company, and it signals that the company is expecting its earnings to fall in the future. So a decrease signals increased volatility and or a decrease in earnings in the future. Generally, when a company decreases its dividends, it's going to result in a decrease in the stock price. It can also result in the executives of the company being fired, because the investors in companies that want dividends value those dividends and value receiving those dividends. And as I mentioned before, some of these investors are things like pension funds and life insurance companies that are counting on that income. And so whenever that income drops unexpectedly, they get upset. And so they don't, companies will often do many things to avoid cutting a dividend. So the implications for dividend stability here: stockholders rely on dividends to meet expenses. Reducing dividends to pay for capital investment can send the wrong signal about the future of the company. Maximizing the stock price requires the firm to maintain a stable dividend policy. This means that dividends should also grow at a stable rate. So dividend policy is set based on the combination of a few different factors. Whenever boards of directors and management of companies set dividends, they have to take into account their optimal capital structure, and the amount of capital budgeting or capital projects the firm is expecting to invest in the foreseeable future. Firms tend to set their dividend policy well in advance, and so it's very predictable. And again, that's what investors want. They want the company's dividends to be very predictable. And so they'll base it on these two things. How much debt are we going to have in our capital structure versus how much equity? And how much do we expect to need to pay out? And so what happens then is they will have their expected net income. They'll be able to forecast that out for several years. They know how much they need to retain based on their optimal capital structure and the amount of capital spending that they think that they're going to need to engage in over that time. And so most companies that pay dividends will follow what's referred to as a low regular dividend plus extras policy. Firms pay a low regular dividend, as the name suggests, based on expected earnings, and pay additional earnings out, and let me say additional excess earnings, because many firms do retain earnings for reinvestment. They'll pay additional excess earnings out as either stock repurchases or special or one-time dividends. So let's go back to the Yardeni research, and I just want to show you that this is actually what most firms do and what we see over time. So this graph here, figure 5, is a great example of the low regular dividend plus extras policy. The green down here below at the bottom is the dividends, and you can see here they're very stable, they're growing. We see a little bit of a dip here with the Great Recession, but then they start just growing. They're again very stable and they're very predictable. Okay. The extras, and I'm not wild about the color scheme here, depending on your monitor and your degree of color blindness. This is either purple or blue or bluish purple or something like that. But you can see here with the buybacks, or also known as stock repurchases, that they're very volatile. Okay, they move up and down. So this is the extras. In years where companies don't have extra earnings, you see this dip right here. This is the Great Recession. In those years, companies didn't have extra earnings. They didn't have money to pay out. So they decrease the amount of their paying out. And in years where they do have additional earnings, they pay out more. Okay, they pay out more. And so we also see again here, you see a big dip in the amount of stock repurchases. We see a small dip in the amount of dividends. Okay, so again, the idea behind dividends is that they are a stable cash flow for investors. Going back now to the notes here, let's talk a little bit about the dividend payment procedures. So dividends are typically paid quarterly. There's usually one increase per year. There are 4 different dates that matter. The declaration date, this is the date that the company announces that they're going to pay a dividend. The ex-dividend date is a strange date, but it's an important date for investors. So if you purchase the stock before the ex-dividend date, you'll receive the dividend. If you purchase the stock on the ex-dividend date or after, you don't receive the declared dividend. The ex-dividend date is related to the next date, the holder of record date. For the New York Stock Exchange, the ex-dividend date is 1 day before the holder of record date. And that's going to be pretty consistent with different markets, but the ex-dividend date depends on the market you're trading in and the rules of that exchange. So the holder of record date is actually announced by the company when they announce that they're paying a dividend. They'll say the holder of record date is this. What that means is that whoever owns the stock on that date receives the dividend. Whoever owns the stock according to the company's books on that date receives the dividend, and the ex-dividend date is set by the exchange, saying, okay, the company needs time to update their books. It used to be for a lot of exchanges 2 days beforehand, so you actually had to own the stock for a couple of days before the ex-dividend date, before the holder of record date, in order to receive the dividend. So this date determines when the ex-dividend date occurs. And a good way to think about this is just the name ex-dividend. That means it's trading ex-dividend, exclusive of the dividend. It's not you don't receive the dividend if you buy it on that day or after. Okay. Finally, there's the payment date, and this is when the investors are credited, their accounts are credited with the dividends. So what effect does the payment of dividends have on the price of the stock? When is the stock price affected? There's only 2 days in here when the stock price should be affected by the dividend payment. So the payment date actually doesn't have any effect on the stock price. The holder of record date does, but that's not when the stock price is affected. The days that affect the stock price of the firm is the declaration date, and only if the dividend is somehow a surprise. Okay. So if Walmart is paying out 50 cents a share for their dividends, and I don't know what they are right now, but let's say Walmart's paying out 50 cents a share every quarter for their dividends. If they're just doing that and that's what people expect, when they announce another 50-cent dividend, there's not going to be any change in the stock price. There's no new information there. There's no surprise. However, if they come out and say, we're paying $1 dividend this time, that's going to have an effect in the stock market. And usually, because it would be a large surprise increase, the stock price would go up as a result. So, if the dividend is a surprise, then the stock price will be affected on the declaration date. Okay. However, if the dividend is not a surprise and it's what is expected, there still is an effect on the stock price. The stock price will fall by approximately the value of the dividend, or the amount of the dividend, on the ex-dividend date. Because the day before, if you bought that stock, you were getting the dividend. You're getting a cash flow from that stock in the near future. However, if you buy it the next day on the ex-dividend date, that stock is now worth less to you by approximately the amount of the dividend, because you're not going to get that cash flow. Whoever owned the stock the day before will get that cash flow. Okay. So that's where I'm going to stop this video. And then the next video will deal with distributions through stock repurchases and how those work. Please let me know if you have any questions.